Okay, welcome to the Compassionate Capitalist Show. And I'm excited to have my guest here today, Carl Dakin, because we're going to be talking about raising capital through equity crowdfunding. And this is something that is um, new to a lot of people. So if you've not heard about crowdfunding or equity crowdfunding, didn't know you could raise capital this way, are struggling to raise capital, this is a great opportunity for you to learn really about the spectrum of that. And also, if you have been hearing my stuff over the last several months about the launch of my new book, my old book, Inside Secrets to Angel Investing, still relevant, and my new book, right? For you tuning in to learn about investing in crowdfunding companies, you're going to get a whole lot of gold nuggets on that as well, because we're going to get into all of that. And Carl I know Carl through Super Crowd, Devin Thorpe. And if you're listening to this after my book came out, Devin is who wrote the foreword in my book. And whenever you happen to listen to, go to the Super Crowd 25, and you can either get into the live streams and watch those, or the recording of the live streams. And it's like 2 full days of panels and people talking about all the aspects of crowdfunding, and even some companies pitching their deals on crowdfunding, because one of the main things about crowdfunding to put in your hat right now, it is significantly different than the reg most people raise capital. And we're going to get into some of the gotchas out there, but there's a lot of people that act like they're doing crowdfunding and they're not actually legally set up to do it. And by that, that means that if you're not set up to do it, we're going to talk about what that means in a minute, you're breaking a securities law. Hello. And it may not bite you right now, but it will likely bite you in the future if you raise capital that way. It is one of my things I teach in my course, to ask companies, how did you raise your prior capital? So if you're out there doing hiring somebody to send out LinkedIn messages for you to people that fit some kind of search criteria, that's general solicitation. That's a no-no if you're not authorized through one of the ways we're going to talk about. So stay tuned if you want to hear how to do it right, because Carl is actually an expert in that. I'm pretty smart when it comes to that, and I kind of know the big picture, but I look at people like Carl to be the one that does it day in and out and is a master at it. So here we go. Let me tell you a little bit about Carl. He is a professional entrepreneur, and he is a startup business designer and growth strategist. And that means he's looking, like I advise companies on this, but he takes it all the way through to execution. And that is, what do you got to do this stage, then this stage, and this stage? And how do you connect the dots and climb that stairs, right? Totally a capital coach, very similar to me. He's a private economic developer, similar to me. You might think that we're like brothers and sisters or something in this world of crowdfunding. I think, we are in a way, because we both have common goals in what we want to do with this. He's got 46 years experience acting as a consultant, advisor, legal counsel, expert witness, investor, principal, investigator, educator, officer, director, and a large number of private businesses, educational organizations, professional associations, and government agencies. And so, with that, say welcome to the Compassionate Capitalist Show, Carl. Great to have you here.
Thanks, Karen. It's great to be here. Crowdfunding is one of my favorite topics. And yes, I was way back at the beginning, which now goes back 9 years, or
Yeah.
it's 13 years since the Jobs Act passed. So it's been a long time getting to this point. And the good or bad news is we haven't touched even 1% of the potential of this
Isn't that
form of
amazing?
crowdfunding. Yeah.
Yeah, it really is. I mean, and on an aside, this is all script, but my big mission is to bring a whole lot more investors to the market, to try to create a balanced ecosystem. So many more entrepreneurs than investors with the Compassionless Academy and the new book. And so I look at stats, right? And so for the angel investor community that are the traditional high net worth accredited investors out there, that is it really, since I, back 20 years ago when I was running my angel group, it hasn't changed much. It might have gone from 275, maybe 300. It last year, ACA Angel Capital Association and New Hampshire, University of New Hampshire Venture Capital Research Institute both came up with very numbers 350,000 accredited investors in angel groups. And this is self-reporting angel groups to say this is how many members we have or how many people and how many investments and things like that. Right. So there's maybe some outside of that. They're informal and things like that. Doesn't count those people that are in like these boutique VC funds and those kind of things. But the equity crowdfunding, Reg CF crowdfunding had grown in that 9 to 10 years, 350,000. So I thought, wow. So we went from 1933 when angel investing became a thing because it was regulated that way, or it wasn't called that until the 80s. But when that happened, so that do the math on that, that's what, 98 years, something like that, close to 100 years, 350,000. 10 years, 350,000. So we're on the move. And with these things like Super Crowd bringing us all together, the biggest challenge we have is like word of mouth. People just don't know about it. And I talk to my angels and my people. I'm like, no, the reason why nobody talks about it. There's no word of mouth. No, hey, did you stock tip on this? Or, like that kind of a thing. Whereas when the private or it's, you don't hear anybody going like, hey, I saw this really good Reg CF company the other day. You should check it out. Right. There's just none of that. Right. But we'll change that. We're changing that. So, okay. So I want to find out how you first heard about it. You got started like 9 years ago, whatever. So I was running an angel group at the time, really frustrated with the challenge and the exclusion that so many entrepreneur founders face going through the gauntlet, the very narrow gauntlet of angel groups that like I did the same kind of gauntlet, where they weren't either in the right industry, maybe weren't quite ready. They didn't have enough developed or raise capital or whatever the criteria are, or they're not in the city where those angels are located because they like to be close to home, or a lot of times, it's a reality. A lot of angel groups, a lot of angels have a race or gender bias. And so, I was frustrated with the companies that I thought like had merits. And I would tell people when an angel group does their first funnel and they're going to have 3 to 4 companies come in, they screen maybe 10, 15 companies to get to those 3. And the reason why they pick 3, there's 2 reasons. One, they can't invest in all of them because there's not enough people. But 2, they got an hour of presentations and Q&A and socializing and eating and drinking that they have to, the companies are the entertainment for the event. And so that, that doesn't mean that 2 that didn't get in weren't worthy. They just weren't a right fit for that crowd. But if you're in a tiny little town or even in the city of Atlanta, where we only have like 2 real angel groups, word happens. Well, that group rejected them and you kind of get a stain on you. None of that happens in crowdfunding, right? You're not limited. And so that's the thing that I didn't know what crowdfunding was because it didn't exist when I started, when the Great Recession happened. Crowdfunding came out of that afterwards. And when we started, because Georgia led the way before the Jobs Act was passed in 2012, early on with Invest Georgia exemption for the interstate exemption we'll talk about here in a second. I was like, all right, finally, we're going to allow people to be able to talk to anybody, to their customers, to anybody, to be able to raise capital. And this is, break down those barriers between entrepreneurs and investors is going to be so great. Yay. And everybody's going to run and want to be able to figure out how to do this. That hadn't happened yet, but it's working. We're working on it. So how did you first become familiar with crowdfunding, get inspired to get involved in this? To what business were you doing before that you pivoted? Were you already in the capital space and pivoted to motivated money and what you're doing? So talk about a little bit about your journey of how you discovered crowdfunding and why you got passionate about it.
Sure. So the short story is the first 20 years of my career, I was wearing a lawyer hat. but I was working with high-tech startups, anything new under the sun, things you couldn't understand, couldn't explain, and often couldn't raise funding for. And after 20 years of that, I decided I'd rather drive the car than sit in the back seat telling my client which way to turn. And so I started putting together a series of projects and funds and companies where I either was a principal or I was the lead cheerleader, but I was organizing, I was getting everybody ready for the funding. And so by the time we got to the Great Recession, I'd already seen a lot and covered a lot of bases, worked with industries and markets all across the board. And then in 2008, the Great Recession happened, and the government suddenly realized that there was no economic activity. And so they turned to the entrepreneurs who, to that point in time, had pretty much treated as wackos and said, hey, we need you to create more jobs. And after a study, it only took them 4 years. They go, well, the reason you're not creating more jobs is because you have no money with which to create new jobs. We should do something about that. So in 2012, they passed the Jobs Act 4 years after the Great Recession started. They handed it off to the SEC, who had no interest in this whatsoever.
Right.
And they took 4 more years in order to put the rules and regs together to make it official. So 8 years after the Great Recession started, we finally got permission to go out and raise money this way. And so during this time, not being happy with the SEC and what they were doing and seeing what Georgia had accomplished, I in Colorado led a group and we passed the Colorado Crowdfunding Act in 2015. And as a consequence of that, over the course of time, we've only had like 2 successful crowdfunding campaigns. Despite our best efforts. And I mean, I set up my own platform. We went through all the available stuff, both off the shelf and hack it together. We ended up doing an offering for a CBD company who unfortunately followed the general rule of entrepreneurs is I'm here, people will bring money to me. I don't have to do anything. I don't have to promote myself. I don't have to do it. And nothing happened. And so we're sitting like, okay, that didn't work. So what else could we do? So we did make some modifications. Actually, we modified the Act 16 times in 4 years. And one of the biggest things we did was he said, if we're less than $500,000, you don't require an intermediary, you don't require an escrow agent. You can do it yourself. You can do it on your own website. And you have to fill out all the paperwork and make all the disclosures just like you would otherwise, but you removed all the time and expense and barriers to that. And since then, with the authorization of the Jobs Act in 2016, we tell people under 500,000, do it here in Colorado because it's limited to Colorado citizens. It's a residents only thing. Or if it's over 500,000, then go to Reg CF and do it on the big board where you have the whole national audience, actually international audience that you can draw upon to be your investors. So, yeah.
Well, I was gonna. I'll come back to you because I'm going to talk about interstate exemption because I had a question there for you. But go ahead and finish talking about that. Was your big power? I mean, I'm just stunned that you were about that with Colorado. So.
Yeah, so since then, I've been involved in a number of crowdfunding campaigns. One Reg A Plus, we raised $1.3 million for a shoe company, a number of smaller campaigns that have been run on the more popular platforms, most of them unsuccessful, which is not particularly surprising because the word crowd and funding have to both be in place for you to get to crowdfunding. The entrepreneur has no crowd, and they cannot build it as a rule. You cannot build it during the course of the campaign. It takes too long, too much energy, all those kinds of problems.
Yeah.
So if you don't have your crowd lined up, if you don't know how to manage or build a crowd, however you're doing that, then crowdfunding, as much as it's attractive, it's the right thing for you to do strategically. You're not ready, and you need to be ready before you pull the trigger on that.
Yeah, I know that is one of those things. When it first happened, and so many, there was so many stats, I guess, that had been coming out of people that like 3% raised the capital, or I don't even know. You know what I mean? It was just a small number. And the reality is that that was fairly consistent with all types of capital. You know what I mean? Regular traditional angels too, right? Because of one, there's not enough money. But it was almost like that build it and they will come kind of a thing that you were talking about. That entrepreneurs thought it was a shortcut. You know what I mean? It's everybody's trying to figure out just in life how to do what I need to do in the easiest, most efficient way. But sometimes shortcuts are not, they're just waste of time and effort, because you don't get it accomplished because you got to actually go through the steps of the proper, best practices for doing this. And it's been amazing to me that, like you said, we're going to get, stay tuned because we're going to talk more in detail about Reg CF, but how people just, like, I call it scratch and win. All right, I'm going to win the lottery. All I got to do is scratch this off. Ooh, well, it's like setting up a crowdfunding thing. It's like, yeah. It's like, oh, I just got to do is post it, right?
Yeah.
We're going to get into that. So let me, so we're talking about, like, there's 4 types of equity crowdfunding: the interstate exemption, Reg CF, 506C, and Reg A plus. And Reg CF that we've been talking about is the most known. And for those that we're going to stay tuned, because crowdfunding for a lot of people, they hear about it and they think Kickstarter and Indiegogo, because it's amazing how much brand recognition those companies still have out there, given a decade, and they were the big boys then, right? But because, they really were the biggest in the reward space, and for decades prior to 2012 when it was asked, and but they don't. Neither one of them do equity. All the equity-based Reg CF are completely new companies that are out there. And I mentioned some of them before, but the big notables are Start Engine, Refunder, Microinvest, Republic, and then there's some niche ones that are specific to certain industries and things like that people can look into. And yeah, so and 3 of those allow anyone to invest, meaning accredited and unaccredited in general, is what it is. Interstate varies by state. Investors in 506C is the only one that is regulated only for accredited. And for those that are not certain what unaccredited and accredited mean, it's defined as accredited is somebody as an individual makes $200,000 a year in earned income. And they usually have to show it for at least the last 2, I think it's 3 years that they've made that kind of consistent income, or a combined income of 300,000 in your household, or a $1 million in net worth, not counting your home, your primary home. And so it's in today's economy, that's not a big a deal as it was, and it hasn't really changed. I don't think it's changed in 20, 30 years. They keep talking about changing it and taking it up, but because of the need to have more capital, I think there's been pushback that says, why? You know what I mean? This is fine because there is and for the most part on the, there's so many that ways to play. And the only real limitation in the ones that are both is that they have this weird sort of 100,000 unless it's changed number, which is like, what about the 100,000 to 200,000 kind of a thing? So basically, if you don't want to prove that you're an accredited investor, then you just stick to the unaccredited. And that usually means that you have a max of 2,000 in a company or 10,000 in a year, which for, people making under $200,000, that's, or, right around that thing, their liquidity is probably about at that point that they might want to carve out to do that. I have a whole thing that I do about why it's better to do crowdfund investing than it is 401k, but that's for another time. So with that, right, so what that means to you that are listening is that, you don't have to be uber wealthy. You're that 200,000 is well above the mean income of the U.S., but, that is just really about deciding you want to add this asset class or choose it as a primary asset class over ones that are all risky, right? Real estate costs a lot to get involved in. There's a big learning curve on crypto. You can get into the public stocks, but who knows what's going up or down in this today's market. And the big reason, besides making money on equity-based crowdfunding, is that you're helping a company, a founder that you believe in, get with the money so they can take that idea or that passion, that purpose, the thing that they're doing, and put it to work growing a business. So they're starting here with your money and going here. So your investment naturally is from here to here. So when they get there, they exit, right? And that's where Carl and I come in on those capital strategies and things like that. So I'm going to introduce the interstate. So interstate, well, before I do that, I've been talking for a minute. Carl, anything you want to add about sort of that origin and philosophy of why people should look at this kind of stuff as an investing before we get into the details of each type?
Yeah, the only thing I would say was that angel investors, which make actually up only the top 3% of the U.S. population, um, they have all these choices. They don't need to use crowdfunding in order to make an investment, but they're going to find a whole lot of new things to look at under crowdfunding because they're only going to be offered within this set. So you see a lot of smaller companies, a lot of startup companies, a lot of innovative things, a lot of cool companies that aren't big enough yet, aren't necessarily going to have the high ROI that is commonly looked for in an angel group or in a private equity fund. So it opens the doors in so many different ways where more companies can participate in raising capital. But it was primarily created for the non-accredited investor, the other 97%, as we call it. And in my mind, strategically, that's why I look at crowdfunding completely different. I think of crowdfunding as being targeted towards your customers, towards your network, towards your community, not so much a person who's trying to get richer or get rich for the first time.
Yeah, so it's like I totally agree. That is your built-in automatic market, and they're the ones that when you're raising capital, the very first money in. So this is also digressing. Is this a subjective or objective investor? So your first money in might be called friends and family in the angel investor world. So those are people that I say are 2 or 3 degrees separated. So they know you as the founder and trust you to do what you say you're going to do, or they're subjective in that they're connected to the product that you're building, and they go, "Oh, I can't believe nobody's ever done that before. I would totally buy that if it was available." So like doctors do that with medical products very easily. They're an easy built-in, so there's always like this avatar. And so what equity crowdfunding does is say, my customers are that. They already know my product. They trust the company. They may not know me, right? And so, give them an opportunity to share in your success as you grow, right? And they're like, "Oh, you mean I love this product? You mean?" Because I look back at Warren Buffett. What does Warren Buffett used to always say? He would say, "Invest in what you know." And if you you walk into Home Depot and you go there and you spend your money there on a regular basis, go buy Home Depot stock, right? Well, that's the same thing, but you get to do it when it's here. Again, remember this? That's how it grows. So you don't want to do it. You don't want to invest like to not make money. You're investing to make money, right? But you get to make money investing in something you're passionate about. So interstate. So interstate exemption, so every state is different, because I was going to ask you, did Colorado have one? And I had forgotten from our very first conversation that you had been a part of that. So yeah, every state is different. So for those listening, you got to look and see if it's even available. I think it's 33 states now offer it thereabouts. When I wrote my book and published it in 2017, the one behind me, if you're watching Inside Secrets to Angel Investing, at that time it was like 43 of them had it on the books. It was like almost everybody had something on the books. And And like some of them had real barriers to success, like you described. Florida, the guy down there, he's been trying to get their locals to similar. They had to have a portal. They had to have 2 years of financials. They had to have all this stuff, so, and he said, there's enough security laws. The whole reason why is because they're trying to protect the investor. So we want to make sure that they've got all this kind of stuff, which is really not a measure necessarily of success. There's other factors of that, but they wanted to protect them. And he says there's enough protections inherent in the security laws that we don't necessarily need to do that. I love what you guys did with the 500 to and then 5 million. So in Georgia, you can raise up to 5 million from accredited and unaccredited that are residing in the state, and you're operating or incorporated out of the state. And you can solicit in any way you want. And it's just a simple form that you file with the Secretary of State. It's really pretty straightforward and simple. But we've only had in that decade, last time I checked, and I've been trying to go back and find the new numbers, and I guess maybe they got embarrassed and they pulled it down, but they used to have it listed of who had filed, and it was only 100 companies. Like in what was it, 2012? So in 22 was when I looked. It was like at that time it was 100 companies in 10 years, and we were bragging because we were like one of the states that had done the most, and I was like, that okay, we're the worst, we're the best of the worst, okay. But it's still, like you say, I like to use, if your state offers it, depending on the way their rules are, it is a great way to get working capital from your friends and family, particularly even when you're first starting out, to set the stage to pay for what you've got to do in Reg CF or these other things. Because none of this, raising angel money, raising crowdfunding money, none of it is free. It costs time and money for both of them. Just plain simple, right? So you got to get your ducks in a row and know what you're expecting to spend in order to be successful. You're investing in the success of your capital raise. So let's talk about Reg CF. Okay. So, I mean, because you've already talked about anything else you want to add about interstate?
No, the only thing on interstate, just make sure people are clear. That means you can only raise money from people who are residents of your state. You're not allowed to cross state lines. At that point, it becomes a federal matter, and then you're limited to Reg CF. So
Yeah.
there are certain times raising money in your backyard. Your backyard is your state. In some cases, you may have customers, people you know all across the United States, and interstate may not be a good fit.
Yeah. Well, and I'll say one of the things I've been promoting, like to the local chambers, for businesses to learn how to invest in other businesses, is like, and I use this example, the coffee shop that you love to go to down the street, that you go and you have meetings and you meet with your gal pals or whatever, you walk your dog there, whatever, right? They want to open up a second location in the town next door. But 20-minute drive away, people don't drive 20 minutes out of their way to go get a cup of coffee, right? And so, you know, and but maybe those people are in that town, that other town, or maybe somebody's come there, from there, because I've had people from, in my case, Peachtree City to Fayetteville, right? I say, so say that company wanted to open up a second location. I proposed this to a yogurt shop company that was open, and I know a coffee company here in town did do it, in Atlanta did use this, and you put a QR code on your counter for your customer. You sign up, you make it official with your state. You put a QR code and say, "Hey, we're expanding. We're opening up a second location." And they go get an SBA loan. Say they needed 75K to open up a second location, and they can go get I'll make it easy, 100K, because they could get a 75 or 60K express SBA loan, and they need to raise 25 or 30 or 40 or $50,000 more to build out the location, things that the SBA loan's not going to cover, right? Hire up more people till they get more customers in there, a marketing campaign, all those kind of soft dollar things that ensure their success. And they say, we're inviting our customers to participate in our next location and share in our revenue. Scan the QR code to see if you qualify, right? And then it's like, what state do you live in? Da, 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 right? And it's just like some basic stuff. And then they see, and they can put $500 in, and they'll get a share of whatever percentage of revenues being allocated to pay the people back. I suggest that instead of equity, because somebody's doing a coffee shop isn't trying to build it to sell big dollars in 5 years, right? And so they're just that way they can just share, and that person gets a check every quarter or month or whatever until double, triple their money has been paid back. And to me, that is such a great win-win for a state, a community to use interstate exemption in their state to do exactly that, right? And that's the simplest sort of way that you can really help Main Street businesses be better, create more jobs, right? Provide more value to the community, and you get to share in their success. It's just really that simple. So, Reg CF, it has evolved over the last several years from where it starts. So, why don't you define Reg CF for folks and how it's evolved, and then that is really sort of your real sweet spot, and we'll get into the ones that are more complex, but talk about that and some of the best practices of things that you want to make sure companies know about when they get ready to start deciding to raise capital that way.
Yeah, so Reg CF is brand new. And unfortunately, as you described, a lot of people don't know it even exists. But if you want to raise money in the United States and you want to raise money from people who are non-accredited, making up the bottom 97% of our population, you can raise money from them, but you have to jump through a number of hoops. You have to file certain documents with the SEC called a Form C. You have to have certain information on your background, where you come from. And it's just a disclosure. It isn't a merit review. You don't have to say, I'm this tall. You just say how tall you are, and that's all fine. You have to work with either a broker dealer who is doing this, or a special platform that's been licensed and approved by the SEC and FINRA. And I've helped one company set up their platform for faith-based and community-based investment. And there are a bunch of rules about what they can and cannot do. But at the end of the day, if you have 18 years of age, any income at all, you're allowed to put 5% of your money a year into one or more investments. And so as a result, what they've done is they've pushed down the dollar amount. Theoretically, they can do a $1 minimum offering for this. But what we found is that somewhere between $50 to $100 is a lot of cost associated with marketing, promotion, all the other things that go along. So kind of a standard that's evolved, but it's not written anywhere. $100 is kind of a minimum investment. And that becomes something that almost everybody can afford. So now you can pitch to everybody. That doesn't mean they're going to invest, but it's greatly opened the door to the entirety of the population instead of just the top 3%.
Yeah. So, and when somebody gets ready to, a couple of things that I think are really important for people to understand, and we kind of talked about this at the top. Uh, build it and they will come, right? The Reg CF platform is part of where they're, when the SEC passed this part of it or authorized it under the Congressional Act, their big concern, and the whole thing that SEC does is protect investors. So the big thing is in the stock market, and there's like this full disclosure and transparency of public companies because anybody can buy stock, right? There is no limit on how much you can buy stock or anything like that, or who can buy it. And so they've, expected that there would be people that aren't those sophisticated high net worth people, that they sort of assume accredited investors are smart enough because they have all this money that they can discern all this stuff. And that's not necessarily the case, as we discover along the way. But the people that don't have that much money clearly don't know how to discern, right? And so we have to protect them.
Yeah, well, I'm going to argue over that. I've had a number of arguments with regulators where they immediately assume if you're not accredited, you're an idiot.
Yeah.
And then I get into it because I go, well, here in Colorado, we have legalized gaming. And Aunt Maud, who's the classic figure that's tossed out by the regulators, they don't want her to put $100 into a local business, but she can go to the casino and put her entire savings on the line in an afternoon, and there's no restriction whatsoever. So there's no
Yeah.
common rationale in that regard. But the other thing is that it's all based on wealth, accredited versus non-accredited, not about what you know. And I joke often that on a good day, I'm an accredited investor. On a bad day, I'm not an accredited investor. And then next week, I might be an accredited investor again. And even though on a bad day, when I'm non-accredited, even though I teach and I know all this stuff and I've written all these things, I can't invest in an accredited deal because I'm not wealthy enough.
Right.
So the point I make though on how smart they are, I go, so you're telling me somebody can buy an $85,000 pickup or a $400,000 house is too stupid to make a $100 investment in a business, down the street. I said, there's no way you can back that up. And if you say it publicly in a big mob, maybe you won't survive. But just think about it that way. Yeah.
Yeah, and Carl, I've sort of fantasized. I'll just confess this, but I say it, in this day and age, it seems like if you say a maybe truth enough times, it becomes a truth. It becomes a fact if you say it enough times. So I have fantasized that part of the conversation and the rationale down the hallways of Congress at the time was, well, we don't tell people that they can't spend, we don't limit their ability to spend $500 a month on lottery tickets, or to your example, go out and spend $20,000 at the slots machine in Atlantic City or Vegas. Why are we telling them that they can't, they're not allowed to invest in the businesses down the street or the next big thing that they want to do? Because, one of the things about reward based, and I use this example a lot in my book, that things like 3D printer, smartwatches, drones, Oculus headsets, all came to market under reward based, where people put $1,000 in to get this piece of equipment before it was generally available, or this piece of technology. And then a few years later, I love to use Oculus as the example. In the book, I give the exact numbers on everything, but Zuckerberg buys this kid out of a garage's technology for Meta, for Oculus headsets, $800 million. And what did those people that put $1,000 into reward based have? A obsolete piece of equipment. But had they had $1,000 in stock, what would that have been worth? 8,000? 80,000? We'll never know, because guess what? They weren't allowed to do it, even though they were allowed to buy $1,000 for this new gadget, right? So that's that thing. But so hopefully everybody got that point. Take my course, read my book, and you'll understand everything you need to do about that. So Reg D 506C. So this came out of, in the traditional angel world, Reg D 506 is what most accredited angel groups, they get a private placement memorandum, and they would review that, discloses all the risks, a whole lot of legalese stuff in there about the worst kind of business plan you could ever imagine, because it's all like if a lawyer wrote it. Sometimes these things are 100 pages long. They're just they're like, really not, but, and very few accredited investors actually read it. You know what I mean? They're just going through and looking for the dilution aspects and things like that. And so the Reg CF was brand spanking new. It was the last one to get certified or get ratified or whatever. And then, but I believe Reg D 506, or was it Reg A Plus that was the first one? Was it Reg A Plus? I think it was Reg A Plus that was the first one.
It was Reg A Plus, and then they took 506C. They put part into B, which is the former private offering, and then they allowed you then to publicize only to accredited investors within 506C.
Yeah.
Which stripped a lot of the, I will say, goofiness and everybody doing it anyway without anybody getting punished for it.
Yeah. And the main limits is like who can invest. So to your point about interstate and Reg CF on a global thing, there are some platforms that will discern, are you local, are you not? There's some, and there's a way to do that. So, you can be soliciting investors, but they can only invest in this one if they're in the state, and this one anywhere. But, your messaging can be similar. Whereas with 506C, with 506B, you basically, investors self-certify. Nobody asks, are you really accredited? They just say it. And all the company has to do is collect a piece of paper, this investor questionnaire that they said, yes, I am. They check the boxes and they do it. And so but that's for B. On C, they have to prove it. There's 3 ways, right, to prove it. One is like you're applying for a mortgage. You submit all of your stuff. Nobody likes to do that. Accredited investors really resist disclosing their stuff. They really like their privacy. Then you can get a licensed person, a lawyer, an accountant, a financial planner that has a license. So they might lose their license if they commit fraud, and they certify in a letter that you are accredited. Or there's now third-party agencies that you submit that first part to, and then every 6 months, I think, or sometimes a quarter, they check in to make sure it hasn't changed, and then they give you the seal of approval. So it's not as hard as it appears to have been in the past. It's changed. It's easier that way. But one of the things when we talked about, my experience was that people didn't really do this much because there's not a portal. There's not a lot of advertising like you see on Reg CF. There's not a place that you can subscribe. What all the companies that are doing 506Cs, you know what I mean? So it's kind of like out there in the gray matter. And I thought it was really for established companies going out to family offices. But when you and I talked the other day, you're like, oh, no, no, no. It's like the least regulated. So it has become the wild, wild west. So talk about what you've seen in that, because that was just like, really, I want to know, like, who's using this, who should be or shouldn't be using this, and then how are they doing it?
Yeah, so essentially any company can use a 506c offering, and because they can publicize it now, that means they can post an ad in a magazine, they can post it up in social media, they can put it on their website, they can tell anybody. And because it's the simplest, because it's assumed that the accredited investor is either smart or they hired somebody who is smart to look at this for them, they don't put any restrictions. There's no pre-filing. There's none of that stuff. So what we
Oh, wait,
found,
there's no Reg D filing? There's no form that gets filed to do this?
the Reg D is filed only after you've raised money. So you don't have to do it beforehand. So
Oh, I didn't
so
really, I
yeah,
guess I knew that.
yeah,
I'm like that. So no wonder when people are out there, they could be, now how long can they be raising or how long
they
after
have
they've raised their first dollar?
15 days.
Okay.
It's an online filing. There's no fee. It's simple to fill out. I mean, half the questions have to do with whether or not you hired a broker and are you paying a commission? Or are you paying any of your management staff? Are you paying back debts where they loaned money to the company? If you're not doing either one of those, it's a very quick form to fill out. Again, because it's a government form, it's not the simplest thing in the world, and you still may need some help first time you go through it, but it's not a big deal. And that filing goes out to all states. So it's filed at the federal level, but it will tag every state in which you're raising money. Now, if you are raising money through 506C and you raise it in a particular state, say Colorado, there is a secondary filing that you have to do in that state. You have to pay a fee in each state in which you receive funding. You don't have to necessarily pay a fee unless you're out there, but some states, there's like 2 or 3 of them want you to file in advance and pay a fee and then another fee on the back end. But 47 of the states is pretty straightforward. 3 or 4 of them have no fees whatsoever or don't require you to file. And but you do have to track it on a state by state basis because will be both a state regulatory level and a federal regulatory level. But because it's simple, as I say, you can raise money on a cocktail napkin. You can talk to the person, and because they're accredited, there's really no consumer protection in place. So whatever you say has to be true. It has to be complete. But if you can get it on a cocktail napkin, you don't have to do anything more. All the stuff that lawyers do and I do and have done in putting together these long offering documents is try to prevent them from suing you later because you didn't tell them something. It's kind of like
Right,
an
right.
insurance policy. Well, they can't claim I didn't tell them because it's all here. It's in this small novel that I just wrote. But because it's simple, and you can even do small offerings. And what I often do is somebody comes to me and they said they need to raise money. We develop a long-term strategy, which may be 1, 2, 3, or 5 different levels of raising funding over time as they grow up. But out of the gate, there are friends and family deals which they can do, which may or may, qualify under local laws. There's usually a 20 minimum investor rule before you have to file anything, or a certain dollar amount. And if you don't hit either one of those, then you don't file anything anywhere. But if you're going after bigger dollars, then you look at it and you go, do I need to go fast and therefore go to accredited investors because I don't have time to do all of the marketing, all the promotion, all the stuff that Reg CF will require. I need the money yesterday, common response. So I need to find 4, 5, or 10 investors who will pop in 25, 50, $100,000 a piece and get going. And so that's what we do. And you can run a 506c campaign, accredited only, and you can run a investment crowdfunding at the same time. You're going to package them differently. You're going to give this group one set of outcomes, and the other one you're going to give a different set of outcomes, which allows you to do a better job of tailoring your offer or your pitch to 2 different groups who have totally different interests in what they're talking about. So I'm working on one that we're setting up where we're going to do maybe $3 million to accredited, $2 million to non-accredited under Reg CF. And they're going to be, the packages probably look radically different because when you start throwing 100,000, 500,000 into a deal, it's probably return on investment is your primary goal. If you're going to the customer, I have a total consumer, let's make a bargain type of a approach to doing that, which is radically different than going to somebody looking just for ROI. So
yeah. Okay, so that's a great, because I have a question about that, but right now, because of what you just said, I think people would be like, how do I reach this guy? So I have your website as Dakin Capital, DAKIN capital.com. Do you also have Motivated Money as a website?
No, I don't. I have a YouTube channel called Motivated Money, but if you want to get a hold of me, go to my website. If you have a hard time finding me, just look up my name on LinkedIn. And also, if you Google me, there's about a 95% chance that my name, which isn't that common, it's me instead of somebody else.
Yeah. Okay, so on the 506c thing, do they have to file in these different states if they haven't raised money there, or it's just so it's similar to the old Reg A with blue sky laws then?
It is. Yeah.
Now, was that always part of 506c? Because I don't
Yep.
really remember all of that as being it. So it went downstream. Because I remember there was a fight between the state regulators and federal because it was taking that away from them with Reg A plus. So they attached it to 506c.
Yeah, the Reg A
I missed
plus,
that memo.
Yeah, also allows you to raise from non-accredited investors. But it has some different rules in terms of using platforms and things like that. So if you're going to go over $5 million, which is the current maximum you can raise under Reg CF, then you would look at Reg A plus if your investors are going to be non-accredited. And
right.
So as you said earlier, there's lots of choices out there. If you're an investor, it really gets down to the terms of the deal. You're not so much concerned at how they got the pitch in front of you. You want to look at what they're offering to give you. But if you're raising funding, you really need to understand who you are, where you're at, how much money you need, where you're on your path, on your journey as a business, and then look at which one fits best, which one matches up with your investor candidates best. which one is easier to implement, lower cost to implement, because they all take time and they all take money. It's a lot of people, I give them grief. I go, well, what's your cost of money? And they'll tell me, well, I was doing promissory notes at 10% interest. I go, that's good. And then what was your cost to raise the money? And I said, you need to add that to your true cost of money to know what you're doing. And one of the problems with Reg CF is the platforms at the federal level charge a commission, success fees, they call it, which doesn't necessarily represent anything that looks like marketing that you might expect from a broker. The broker is an intermediary who provides a service of bringing you together, and making a deal happen. And for that, they get paid a commission. A platform is high. It's a sign along the highway, and they're not marketing, they're not promoting, they're not pitching, because they're not allowed to.
Right. That's a big thing that people don't understand.
They don't.
They're not allowed to.
And the charging the commission makes it look like they're going to be doing marketing, but they're not.
Yeah.
So, I think that the commissions that are charged are commonly way too high for what people get out of it. And so for small dollar campaigns, that cost becomes fairly steep. I've seen total cost of campaigns go over 20% for Reg CF by the time all money's on the table. And that's probably more than you can afford. And particularly based on your profit margin and where you're at in your business.
Yeah. A couple of caveats on that too is that with Reg CF, you've got to hit a minimum of what you need, or else you don't get the money. It's held in escrow by the investor. So to you as an investor listening, you can put something in, and if they don't get, like, say they're going to raise $500,000, right? And their minimum is 150. If they don't get to 150, all of that is given back to the investors. Right. So there's that particular protection, because one of the big things you want to make sure a company has the ability to do is to be able to raise all the capital they need. They know how to raise capital, because that isn't all. They're going to need more after that, right? And so they have to understand, the mechanisms of how you communicate to investors to get them to trust you, right? To know you, then trust you, then buy, right? So that's the first thing. And then the other thing to the Reg CF, marketing stuff. So because of this general solicitation thing and that idea of picking and choosing or whatever, you know what I mean? Or not having the platforms liable for a company not being, like, they're responsible for selling it, and it being more like what we talked about, your customer, your crowd. You have your own crowd, your tribe is sometimes they call it, that about, right, in the industry, that are going to, invest in you. They are allowed to do things based off of milestones when you sign up. So they have a captive audience of their emails that are on there, and of people that have subscribed, and potential investors that have subscribed or have looked at another deal and liked it because they had to put their email address. So they get an email. You'll get an email, and if you're an investor, that says these are the new companies this week. And then down below that, it'll be, these are the companies that hit their milestone. And then these are the companies that are closing, or they'll get so-and-so company is about to finish their round, get in while you can, right? So there's or if a company does a webinar, investor webinar, communication outreach, they'll announce an event that they're doing within their platform to the investors. And so it's very structured on how they do that. And some of them get around it, because like Start Engine has an accredited arm that invests in a fund, and that fund invests in the higher end kind of deals that are just for accredited investors. And then you can follow on that investor. WeFunder has a VIP thing that is just for accredited investors that get special terms, special discounts off of the offering, it might be 10% off of the initial offering as a VIP. So they try to differentiate the randoms to the ones that are actively participating and doing that kind of stuff. So that's something to consider as you go forward on this. So let's talk about Reg A Plus, because Reg A Plus, and Dave Wield was the guy, Sherwood Nice was the guy that was really the champion lobbyer for the bottom end of the spectrum, Reg CF. The other things just sort of filled in because they were already existed under Reg D, and then David Wield was the guy that championed Reg A plus because he said, well, we're losing our competitiveness in the world stage because our number of IPOs is going down because we have because of Sarbanes-Oxley, we created such a barrier and how hard it was for companies to go public, right? I mean, and that was as a result of fraud of public companies, but they created all these rules. The pendulum swings, right? And so Reg A was a way to split what was there, and you can raise up. It started out at 25, now it's up to $75 million with unaccredited and accredited. You have to file SEC level audited financials with the SEC, and you can do pre-marketing while they're going through that, but you don't have to do the blue sky laws. The Reg A type 1 still does blue sky laws. 506C, by the way, is unlimited amount of capital, which is kind of crazy that you can raise unlimited amount of capital that way. And so it becomes a back door into being public on the OTCBB market or NASDAQ small cap. And then based on your filings and your good reporting and all this kind of stuff, you can work your way up the food chain into, fully reporting, fully trading, things like that. So that's something. And as a result, I think they've now like 4 different classes of over the counter. That's what OTC stands for out there. But it is one of those that also no broker dealer. You have to have a transfer agent. There is platforms that white label to do that, but there's best practices of deal rooms and things like that. Most companies usually do it in tranches of 20 million because you kind of set the value of what your stock is. But if you raise 20 million, your value has gone up. And if you do something with that 20 million, like another product or make an acquisition or something like that, your value goes up. So they like to do it in multiple tranches in order. And tranche is just sort of like the word that people use. It's like a weird word. I think it's an English word. I'm not even sure where it comes from. It's not a trench, it's a tranche. And it's like, it's like it's scheduled type of investing or investments in companies. It's a tranche is what they call it. And so it's really interesting. And it was the one that was so flexible, but compared to what you said about 506Cs. So I know you said you had raised like some kind of money, you made some money on Reg A plus. Talk about your experience with Reg A plus, because I think it's really exciting that you really run the gambit of this and have such a bird's eye view of what's right for a company, depending on their stage and industry and types of customers.
Yeah, so when we did the Reg A plus, that was way back when Reg CF still had a $1 million limit at that time. So we wanted to raise more than that. Our goal was $3 million. It was for a company that had been around quite a while, worldwide, 30,000 customers. And we need money basically to refinance a whole bunch of different forms of debt and restructure equity and things like that, so the company could break out, and which is what it did. So we put it together, but the back office is something that you can manage yourself, or you can use an off-the-shelf platform, which is different because it's not commission structured necessarily.
I know.
It's an admin fee. And that's why right now in this one project, I'm asking myself, well, maybe I should raise $5 million $1, push myself into Reg A plus, miss all these commissions I would pay if I used a regular Reg CF platform. And that's one of the things going on. I've got a call on Monday with one of these offices. There's several platforms out there that basically white label, you put your name on it, it's got all the information, but it looks like it's just jumped from your website to another page on your website. But it's got all the tracking information collection, response, auto response, all good stuff. And you're going to pay for that. But if you're going to raise over $5 million, then in the scheme of things, this cost is nothing. You're still back to marketing, promotion, letting people know you exist, talking to the right people, making sure that your pitch matches up with what they're interested in. All the usual stuff of raising money, no matter how you do it, is there. But once you start getting to large numbers of investors, large dollars, then you get to do a little bit more. Maybe drive the Cadillac instead of the pencil.
Yeah, so a couple of points to point out about that, about Reg A Plus, is I mentioned the SEC audited financials, right, or the SEC level of audited financials. So by that's not every accountant, not even everyone that can do audited financials can do SEC audited financials. And I forget the name of the company, but there was a pretty prominent company that got into hot water because they did audited financials, but it wasn't by a firm that is licensed by the SEC to do audited financials. And they got fined a bunch of money because they didn't file the right kind of audited financials, which I thought was, like give them a warning or something. I thought that was crazy. So you want to make sure about that. And kind of the nature of audited financials means that you have something to audit. So it's really not geared. They frown upon startups, and the Nasdaq stopped letting companies raising capital Reg A Plus go through to be on OTCBB for a number of years because there was just kind of like what you just described with 506C. It was like a no man's land. Everybody was just like, oh, I had startups. I remember people like, how can you do in a startup as that? You know what I mean? And so when the SEC kind of tightened up some of those rules, and it had operating history, then it became something that they opened it back up because it was got a lot cleaner in that regard. So that's one thing to really keep in mind, that piece of it, right? Yeah. What do you want to say?
Well, I was just laughing. A lot of people may have heard of SPACs, special purpose acquisition companies. And every now and then the SEC lets something through the door and you look at it and you go, this fails everything you've been yelling at us about for decades. It doesn't do this, it doesn't do that, it's speculative, there's no asset behind it. And yet here we go again. And SPACs were one of those things. They created a company, they pooled money with the intent of going out and buying a non-traded company, bringing the assets inside with the expectation that the total value of the company was greater than the cost of acquisition, everybody would make money. But that happened for a few years. Then we have the unicorns where they got to $1 billion plus valuations with no revenue. And you're like,
Yeah.
oh, that's interesting.
Yeah.
So yeah, the fact that it's legally being available for sale doesn't mean it's a good investment. If you're an investor, you have to do due diligence, or you have to get somebody to do it for you. One of the problems with crowdfunding is the deals are so small that you really can't afford to spend a lot of time in due diligence. So I, like a lot of other people, have joined a investment club where we take turns doing due diligence. One person will do a deep dive 1 month, and somebody will also do it the next month. And everybody hates my due diligence reviews because I'm always asking hard questions.
Yeah. You got to ask the hard questions, though, because at least at the very, very least, if it goes south, you can sleep well going like, well, I did the best I can, versus when I first got started with Angel, with the Angel Investor Group, and I was meeting these angels, and I said, well, how'd you learn how to invest? And they would say, well, I lost money on my first 3 deals. And then I started to figure out, and I thought that's a real horrible way to learn how to invest. And every investor, though, has this hidden checklist of the things they'll never do again. And that's the one. And every investor out there, like a serious angel investor, they all have the same thing. I have it myself. Like, I knew better. Like, I didn't ask this question. I thought about it, but the emotional side, it's like, I'm a big in my teaching and my course. It's like, creating a framework that helps people avoid the emotional investor. Now, if you're doing investment, if you're doing Reg CF, $100, $500, that kind of a thing. Like, so I'm going to share this sort of at the end, and then we'll wrap up with you, letting you close out anything you want to talk about. But I think it's important to put out there, because people have been so conditioned that, what if you want to create wealth, then you got to be an entrepreneur, right? Without ever thinking about the most famous entrepreneurs that you aspire to be didn't do it alone. They did it with investors, could be 10, 100, 1,000 that put money in so that they could use that money and go do what they said they were going to do with it and build a company that that investor benefited. So they rode the coattails of that entrepreneur to wealthy land. Okay. So that's one thing. The second thing that people hear a lot of times is, particularly if they're a working person, right? Corporate America, working in whatever, invest in your 401k, save for your retirement. Okay. Well, most companies don't match that until you've been there for 5 years. The average stay of a person in a company these days is about 3. So you're never getting to the match, which makes sense. When I was at IBM and I expected to be there a long time, the match was great, right? And so, it's like doubling your money. So I did the math because I heard this from a podcast with the founder of Seed Invest. It was Jason Kokonis, who is the author of Wings of Angels, Big Wig, Uber investor, PayPal investor, whatever. And he said, if I could do it over I wouldn't have started. If I could go talk to my 20-year-old self, this is what I would tell myself with what I know now and like what life is today. He says, I wouldn't have started my first company at 20 something right out of college. I would, or in my senior year in college, I would have gone ahead and got that corporate gig job. So I would kind of learn a little bit something about what it's like inside a corporation, what's good, what's bad, that kind of stuff, right? Ross Perot, video like Carlin, I know who he is because we're of the age that remember when we're around when he ran for president. But his big thing, he joined the company. I forget now what it was. But so he could learn about sales inside this company, and then he went off and created Uber Rich by being a sales advisor. And so he had, part of that then he said, what I would do is instead of investing in the 401k, because I wasn't planning on being there 5 years, but I did the math for 5 years. I would put $500 a month into a Reg CF company. And I wouldn't spend much time doing due diligence. I would just pick one I really liked what they were doing and thought it was cool. And I wanted to see that technology or that solution get to market. And over the course of that, so if you do it over 5 years till you got invested in a 401k and it started matching, you would have invested $30,000, okay, 60 companies. And if the VCs and the angels out there do this 10 company scenario where, 3 go out of business, 1 does 10x or more, 2 might do 5x, 2 do 2x, and 3 are kind of a baseline. You get your money back. Okay. That kind of thing. So if you do the math on that, your $500, so you basically do that 6 times. Bottom line, when you do the math on 500 times 10, 500 times, all that kind of stuff. You come out of the end of that, your $30,000 investment has a net return or has a total return of $78,000, even with 18 losses, 18 companies that go belly up. Whereas based on standard 9% of a 401k on a good day, right, kind of a thing, not counting fees, not counting market fluctuations, right? Your number is 35,900. So $6,000 on your 401k in 5 years versus $48,000, 7 times the return without doing any due diligence, just based on numbers and diversifying in lots of different things. So to the listeners out there that are thinking about investing out there, or what do you do to create wealth, right? All that stuff. You can't save yourself to wealth. You invest to create wealth, and create wealth doing something that has potential to create multiples on your money, the way millionaires have done it for, what do we say, 93 years? So I've done it before it was legal, 73 years before it was legal to do crowdfunding investing or something like that. So anyway, that I want to put that out there because I think that's really important for, people to understand how accessible it is. As you said, 18 years, that's it. And you can, put money in and just just get started, folks. There's so much exciting stuff out there that these companies are doing that you'll have a hard time discerning which ones are the ones to invest. And that's why you need to take my course, because I'll teach you how to discern. But anyway, Carl, take it away. What do you want to add before we wrap up here? Because I know you truly are the guy that knows how to figure out for companies about raising capital. And I know you invest in companies as well on all of this stuff.
Yeah, plus I raise money, so I'm wearing all the hats. I'm not missing out on anything. The key thing I tell people in crowdfunding is you should focus on the customer as the potential investor. Then you should understand that nobody who is a customer thinks of themselves as an investor. They don't
Right.
get up in the morning, flip through the Wall Street Journal saying they're going to invest in something. They have a small dollar budget. It's mostly household items. There's no discretionary money set aside for an investment. So when I work with businesses to put together a package, an investment offer, I talk to them as customers. I go, well, what can I give you in terms of free product? What can I give to you in terms of discounts on future products? What other kinds of perks can I roll into that? And yeah, there's an equity piece or there's a wealth building piece, whether it's rev share, interest, or whatever. But I can create packages where, if fully exercised in the hands of the investor, the customer, they might get $300-400 of value out of a $100 investment. And this changes the entire mindset, because this is bargain hunting in its best form right now. It's something they already know they're going to buy because they see the product, they see the value in it, and they feel they're in the driver's seat. Instead of waiting for years for somebody to come give them some money back, they're going, well, if I buy all this stuff, I'm going to make money on that. If someday I get a distribution, a check or something, that's all bonus money. And so it changes everything. How they look at the deal, why they look at the deal, how you structure the deal. And so if I'm going to be pitching to angels, I've got to come up with some other incentive for them to get on board. And 60% of small businesses don't make that much margin, so they're never going to be attractive to a pure ROI type investment. But if I'm talking to the customers, I've got all kinds of flexibility, all kinds of creativity to how to assemble the package, and I should be able to put something together that people go, that's a good deal, let's invest.
Okay, very good. I think so. I love that hybrid, almost a hybrid of reward plus equity kind of model. And I talk about that with companies as well as they're thinking about strategy of how you build this. So I'm looking forward to sending people your way, and hopefully folks are listening, and you're going to go to dakincapital.com and connect up with Carl and get his 2 cents worth on what you need to do to get going. And then, if you've got the resources, the gumption, the idea that you're going to really commit to getting it right, then get started, right? But don't waste time and money doing it a shortcut.
That's right. Thanks, Karen.
All right. Thank you, everybody. Thanks for tuning in. Please share this with somebody you know, and subscribe and follow, like it. All that stuff really counts in order for this content of us growing crowdfunding industry gets delivered to somebody that might be listening to something else. It's the only way it gets out there, that the algorithms of the podcast say, oh, other people might be interested in this. Let's do it, because you get the likes and all that kind of stuff. So with that, onwards and upwards. Have a great day.